What happens if you default on government student loans? Breaking news for borrowers. The question on many minds today is, what happens if you default on government student loans? With recent developments, this topic has become increasingly relevant. Just yesterday, the Education Department began sending out warning letters to borrowers at risk of default. If you are among the nearly 2 million borrowers whose payments are resuming, understanding the consequences is essential. When a borrower misses federal student loan payments for about 270 days, which is roughly 9 months, the loan enters default status. This triggers serious consequences enforced by the government without needing a court order. One major outcome of defaulting is wage garnishment. The government can withhold up to 15% of your disposable income directly from your paycheck. Starting in July 2025, many borrowers will face this risk as federal student loan collections have resumed after a pandemic pause. Another consequence is tax refund offsets. Any federal tax refunds you are due can be seized to cover the loan balance. Additionally, the government may withhold Social Security benefits to repay the debt. Defaulting also severely harms your credit score. This damage can make it harder to obtain credit, rent housing, or even secure employment in some cases. In May 2025, the Education Department began sending 30-day warning letters to borrowers at risk of default. This signals that enforcement actions could start imminently. Defaulting can also have broader financial impacts. It may limit your ability to access new credit and increase financial stress. This is especially true for lower-income borrowers who often carry heavier student debt burdens. There are ongoing policy discussions about how student loan repayment and forgiveness programs might evolve. These changes could affect default rates and borrower protections in the future. For example, proposals like the Biden Saving on a Valuable Education Plan aim to reduce payments and preserve forgiveness programs. This could potentially lower the risk of default. Conversely, other policy approaches might tighten repayment requirements and increase defaults. Defaulting on government student loans leads to wage garnishment, tax and benefit offsets, credit damage, and increased financial hardship. Borrowers should seek options like income-driven repayment plans or loan rehabilitation to avoid default and its consequences.